Joining us now is Daniel Lacalle, CIO of Trusses. Daniel, look, we'll get into the tariff story in a little bit, but it's all about rates that continues to dominate this market. Two-year yields up higher again this morning, 8 basis points. Is it fair to say we have yet to see the peak in yields?
Good morning. I think that we might see another hike that will lead yields further up, but I think we're close. I think we're about 70% into what would be considered a normal level of bond yields, particularly in the United States. I think that the U.S. Treasury will certainly peak at around 3.2, 3.3, according to the rate hike pace that has been announced. So all those things should at least start to calm down markets. I think that right now there's too much uncertainty about what the rate hike would create in terms of the turmoil in spreads. And so far, at least, what we're seeing is that we're very far from a widening of spreads as the ones that we saw in previous tightening cycles, which indicates that liquidity is still elevated.
Daniel, good morning. I'm curious when you say that we're 70% towards the levels that would seem like a normal level of US yields. What's your benchmark for that? Because to put that in context, nominal yields are way below most of the last 5 decades on average. But even ignoring that, put inflation in there, and we're at the most deeply accommodative policy ever seen. So by what metric are we near normal level of yields?
Yeah, I think that it's a very good point, because the key element here is that markets will start to realize as we go into the third and fourth quarter that central banks are going to remain massively accommodative, that financial repression is going to continue, that central banks are not going too far in terms of hiking rates. Therefore, if you think about what central banks have been comfortable with in the last 10 years, which is to see nominal bond yields at a level that is significantly below the rate of inflation that we would think for in the next 5 years, I think that is probably where they'll settle. If even in some messages coming from the Fed, they're saying that the tightening process is starting to get closer to where they feel comfortable. So my personal view is that what markets are still not taking into account is how accommodative central banks want to remain in this tightening cycle. It's certainly not the most aggressive of rate hikes paces that we would imagine.
Daniel, I find this view really interesting because I think there are many people in the market, maybe even the majority, that hold this view that ultimately the major central banks will remain relatively accommodative relative to inflation because they want to have negative real yields. They can't afford to get hawkish. But are you not worried by the massive shift in politics, the fact that in every country the cost of living crisis is the biggest issue, and therefore politically, for the first time in probably 40 or 50 years, central banks are being pressured politically to control the inflation problem, not prop up markets? Does that not worry you?
It does. It certainly does from a timing perspective, because it is absolutely true. But on the other hand, the same governments that are telling central banks that they should tackle inflation are telling central banks to monetize massive deficits at as much as they can. So central banks are caught between a rock and a hard place. They, on the one hand, need to maintain a level of independence that will at least address the inflationary pressures, but on the other hand, what we have is still very aggressive deficit spending from governments that simply cannot afford a massive increase in bond yields. So it's going to stop somewhere in the middle. I think that once we see that inflationary pressures, particularly the Fed's gauge of inflation and core CPI in the Eurozone, start to move a little bit better, then we can see, therefore, the end of of the risk-off process that we're seeing right now. However, what is absolutely true is that what we cannot expect is for them to U-turn. And I think that that is the big problem, is that a lot of people are expecting a U-turn.
Yeah.
That's not what I think. I think that they will hike rates, but they will stop almost halfway where they probably should in order to truly address inflationary pressures.
Daniel, let's translate this then into your market calls. You like investment grade over equities. Is that this idea that the rate hikes, that they'll hit that level where they can no longer go any further, that accommodative stance which you and Mark were talking about that central banks ultimately want to have?
Exactly. What we believe is that we still have another leg down because of the earnings cycle. Earnings revisions are coming down. It's not just a macro call or a rate hike call. It's also that consensus estimates of earnings, particularly in the Eurozone, were very aggressive, and especially for 2023. And at the same time, what we do see is that there is a certain amount of value in investment grade. We think that there's still way too much risk in sovereign bonds. At least we don't believe that there's true value in sovereign bonds, particularly in the Eurozone. And at the same time, spreads will likely rise a little bit further, or at least significantly further, in the high yield market. So where we think that there's opportunity is in investment grade. We also believe that in general we need to see more confidence from companies in terms of their earnings estimates and their guidance in order to be comfortable with valuations.
Okay, Daniel, hang tight. More to discuss. Daniel Lacalle, Trusses CIO.